Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meizinger, your host, and today I will also be the presenter. And I'll be talking about FX options pricing. This is part of the Back to Basics series that we've offered here in 2010. We at the ISE feel that options education is extremely important. So not only are we bringing in special guests, we also have Trading Central that makes trading recommendations. And I'm also giving these Back to Basics classes from time to time, and hopefully you learn quite a bit about that. Robert, if you don't have the audio, you can call in, or you can try to log back in again. So sorry about that, Robert. You can just do that where you can close out and log back in, or you can go and call the 866-469-3239 number. Okay, Robert, thank you. All right, so again, thanks for attending. We're going to learn in the next hour or so more about FX options pricing. Really important that you know about pricing, and why is that? That is the purpose of the currency options pricing, is so you understand how you can implement trades, what are the risks, what are the rewards. So hopefully you'll get a lot out of the next hour. Today, as I go through the presentation, some of the very important factors such as taxes, margin, and commission will not and are not included, but you should always consider those. And also, if you want to learn more about options, you can always go to optionseducation.org. Also, continue to come to the ISE, where each and every week we bring in special guests. And as I said, I will present from time to time. And we also have Trading Central that talks about their trading recommendations. So when you're trading options, you're trading probabilities, likelihood, the likelihood of an event to occur. So if you're looking at the Australian dollar and you're looking at AUM, very interesting. Right now it's sort of right at the strike price, the 89 strikes, a little bit above. And you could make a forecast over the next 6 days, what's going to happen. If you believe that the Australian dollar is going to continue to rally, you might be looking at the AUM calls. And if you thought it was going to, or if you thought it was going to rally and you wanted to take in some premium, you could sell some puts. But you need to think in terms of probabilities. Nobody in the world knows exactly what's going to happen tomorrow or the following day. No one knows that. So when you're trading, you need to think about risk and reward and probabilities, and that's what options pricing is about. So we don't ever really talk about the term impossible or guarantee, but we do use terms such as most likely, most unlikely, probable, and improbable. Those kind of things we will use, even likely and unlikely, but we stay away from impossible or guarantee. Many, many years ago, the Black-Scholes model was released to the public, and that quantified certain risks of buying and selling options, and I'll get to that in just a brief few moments. So where do these prices come from? Well, the first model, as I said, was B and S, which means Black-Scholes, not the S that we talk about so often in, I guess, in our everyday life, but the idea of BS or Black-Scholes came from these gentlemen. Fisher Black, Myron Scholes said, you know what? They thought that the options were about events, probabilities, and investors needed to quantify the risks of being long or short an option. They also felt that these assets had dynamic behavior, so what that means is that they're going to move around each and every day, and then market makers should be able to hedge this movement, and that's, of course, possible by using the option Greeks. Many other models are used, Cox, Ross, Rubinstein, or in the foreign currencies, Gorman, Colehagen. Most are extensions of Black-Scholes. Gorman-Colehagen, the pricing model, well, is very similar to the Black-Scholes model. Gorman-Colehagen takes into account the exchange rate, so that seems pretty similar to what we would have in the Black-Scholes. It's just an exchange rate, not an asset price. Strike price is exactly the same, right, because we know what strike prices are, exactly the same. Time left until expiration, the same. Volatility is also the same. So one big, or two of the big differences, I guess it's one big difference, is that if you take a look at the risk-free rates, that is such a huge difference. It's the risk-free rate of one currency relative to another. And that is the major difference between an equity option and a foreign currency option. But that's really about it. Some of the assumptions of models, short selling is allowed. And of course, we went through some serious debate if that should be allowed. But again, without short selling, the options market almost ceases to exist. So short selling is allowed for market makers, large institutions, what have you. No transactional costs. We know the transactional costs they are down significantly in the last 10 years, but there is, of course, a slight transactional cost no matter if you're a huge institution or you're a self-directed investor. The initial models were based on equities, so they said no dividends. When I'm trading currency options, I don't really care about that. I'm just looking at the interest rate differential. Another assumption of the model is that riskless arbitrage opportunities are not available, meaning that that market makers hedge that out, and that's normally the case. Here's one dilemma, is that trading is continuous. The options market, trading is not continuous. So we only trade from 9:30 to 4:15. Soon we hope to be trading at 7:30 in the morning. That's should be, or we're waiting for the ability to do that. Of course, we're regulated by the SEC in Washington, D.C., and they are hopefully going to allow us to trade 7:30 in the morning. And that's another one of the assumptions is that we have a constant interest rate, and that is not true. Interest rates change. In fact, just last week, the Reserve Bank of Australia, everyone thought that the RBA was going to raise rates, and they turned out that they didn't. And if you watched what happened in the ISC symbols, AUM, which is the Australian-based, or the AUX, which is the dollar-based, AUM took a beating, and AUX rallied on that news. So interest rates are not constant, and if you have a view, that was an opportunity that you actually could have traded that view if you didn't believe that RBA was going to raise rates. So there are opportunities out there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.